It is back to school season again. Are you ready to pay the tuition fee for your post-secondary education program? If you have economic needs, you can apply for financial assistance under the Tertiary Student Finance Scheme, publicly funded programs, or financial assistance scheme for post-secondary students administered by the Student Finance Office of the Working Family and Student Financial Assistance Agency. While most of the applications are successful, every year there are applicants who fail to get the financial assistance because of their mistakes in completing the application form. To help you with your application, we are going to highlight some of the common mistakes. Before we look at the common mistakes, have you ever thought about why you should provide complete and correct information in your application? Providing true, complete, and correct information facilitates faster application processing and accurate assessment. On the other hand, understatement or omission will lengthen the processing time or even result in your application being rejected. Please always provide correct information in your application form. The first common mistake is failing to report the family income of the whole assessment period. To illustrate with an example, a student's father was employed in the first few months of the assessment period, and subsequently has become unemployed. The student thinks that since his father is currently unemployed, $0 should be reported as family income in his 2023-24 application, but this is wrong. The correct way is to report the father's total income during the assessment period, which should be from April 1, 2022 to March 31, 2023. The father's current status of unemployment should be reported under Step 12 of the application for SFOS attention. The second common mistake is omitting other incomes. A mother was too busy to explain her income in details, so she told her daughter to figure it out from the bank passbook of her payroll account. After going through it, the daughter only added up the salary deposits of 12 months and took the sum as her mother's income. She thought she could just leave out the allowance, commissions, bonus, award, tips, etc., but this is wrong. In fact, in addition to salary, bonus, part-time income, allowance, commission, tips, and other income items are all counted as family income. The third common mistake is omitting contribution from others. For example, due to the family's financial difficulty, a student's aunt helped pay the mortgage payment for a few months during the assessment period, and then the student's parents resumed paying the mortgage themselves. The student thought she didn't have to report the mortgage payment made by her aunt last year, but this is wrong. Contribution to family includes remittance, rent or mortgage payment, bill payments, family expenses, and alimony, etc. The fourth common mistake is omitting the contribution from a divorced parent. An applicant's parents have divorced and her father gave her pocket money although he was not living with her. She thought she did not have to report the pocket money received, but this is wrong. Remittance, rent or mortgage payment, bill payments, family expenses, alimony, etc. are all counted as contribution to you or your family. Don't forget to report them in the application. The fifth common mistake is about business and deficit. As an example, the company of a student's father has been in deficit, and the student thought he didn't have to report his father's business because it was not profitable. The student therefore entered $0 as family income and not applicable as assets, business undertakings. However, this is not correct. He should have reported all business undertakings irrespective of whether there were profits, and provided the profit and loss statement and balance sheet. The sixth common mistake is omitting insurance policies held by the applicant and family members. To give an example, a woman was the holder of an insurance policy. The beneficiary was her mother and the premium has been fully paid. She thought it was not necessary to report this insurance policy in her son's financial assistance application, which is wrong. The applicant should report all insurance policies with cash value, dividend, investment or saving elements held by the applicant and family members. The last common mistake is omitting outstanding loans to others which have been reported previously. As an example, an applicant's father lent his brother some money for a surgery 2 years ago. The applicant had reported this outstanding loan in last year's application, so he thought he did not have to report it again this year. This is also wrong. Applicants should report the latest information of all family incomes and assets in each application, including the money lent to others which was not yet repaid. We trust that you have learnt more about the reporting requirements after viewing these common mistakes in completing the application. To find out more about the application requirements, please visit the following websites.